So welcome everyone, welcome. At the present moment, we're going to go through the pros and cons of trading either crypto versus the banks. Now, some of you guys know me and know me quite well, and I have come together with Arno, and we've put a little product together. So what I've done is I've teamed up with Kashti and Mayor. So Kashti and Mayor are an exclusive club in Mayfair, and I've joined that exclusive club. Anyone who has 25 grand in their trading accounts are more than welcome to join me here with a trading floor and join on the trading floor. If not, it's absolutely fine. We're still looking to do some stuff for you guys. And then this is Arnor, who is one of our analysts. Arnor, do you want to introduce yourself and give a little bit of feedback about yourself?
Yeah, sure. I mean, I've been an active market participant for close to a decade now, and for the last 5 years, basically been a professional senior market analyst. So started in the FX space and then moved over to all things global macro specifically. So that means covering a vast array of asset classes: FX, equities, commodities, fixed income, and of course more recently a little bit of crypto as well. So in a nutshell, that's me.
So let's crack on. So I suppose we've had a huge amount of volatility in the market as of late. We have had banks going under. We have had dollar getting weakness because of it. We've had gold getting stronger, and we've also had Bitcoin getting stronger. So I don't know, can you give me a little sort of idea of why the banks have gone under and a little bit at the back of that, please?
Absolutely. I think it's just tell me if you can see this screen that I'm sharing. So I think this basically explains exactly what we've been seeing. In the blue line here, we have the SPDR KRE ETF. So that basically tracks the regional banks in the United States. And obviously the red line you will notice there is Bitcoin. So what basically happened, second week in March, we had a classic bank run on. The first bank that failed was Silvergate. Now, as you know, that was more of a crypto-friendly bank. They got hammered after the FTX collapse. They basically went under as a result of that, as well as a classic bank run when everybody pulled out their money. There wasn't enough money to basically pay back depositors, and the bank failed. Then a few days later, we had Silicon Valley Bank, which was more inclined towards your capital market, so more your tech side of the industry. They got hammered on two sides because they were sitting on massive unrealized losses in their held to maturity account. So what they basically did, they bought billions and billions worth of treasuries. They thought that they would just hold those on their books, get the interest paid at the maturity date. What they didn't see happen is that they would get a classic bank run. Everybody wanted their money, pulled their money. There wasn't enough collateral, and they had to sell all of those treasuries for a massive loss. Then we had that spilling over into Credit Suisse. As you guys know, they were bought by UBS for a shotgun sale of 3.3 billion US. And that led to, I mean, just huge losses in bank names across the board. While that was happening, though, we had crypto absolutely skyrocketing across the board. So that is basically brought about this narrative of, is this a switch? Are we seeing investors switching from your traditional banks from regional banks towards crypto? That's really where we are from a narrative perspective. Now, I don't necessarily.
Yeah, I will answer that for you, and the answer is yes.
Okay, fair enough. I'll share a few charts where I don't think that's the case. But there's been good reasons. There's been good reasons for crypto rallying. I think it's important when you look at stuff like this.
You don't have to show any more. This here tells us exactly why it's kicked off. So if we look at this, since about the beginning of 2023, we did have a run up there on the likes of Bitcoin. And if you look at the banks, it actually was pretty correlated.
Yeah.
And then if you look at that high at the beginning of February, yes. And now it started coming down. And then shortly after, we actually had a drop in Bitcoin. So again, it was pretty correlated. They've sort of been following the same sort of structure until the masses. We found out that SVB was going under. We found out that Signature went under. We also then found out that Credit Suisse is in the middle of an unprecedented time. And then we had the likes of crypto coming back to a really, really nice sound level at that 19,000 mark US dollars, obviously. And then from there, we had that kickoff and it took off. And that's exactly that point there, that highlighted area. That's exactly where, and you can see the inverse or the divergence of the two charts all of a sudden at that particular point. And at this particular point, we have people like, obviously not you, Arno, but like me and every other one in the world is jumping into crypto or jumping into the likes of Bitcoin or jumping into the likes of the altcoins because to them, it's a safe haven. So the traditional safe haven is gold, okay? So we have a lot of people putting money in the likes of gold, storage, the dollar, the gold standard. But for the younger crowd, for the likes of my generation downwards, Bitcoin is our safe haven for us. It's decentralized. People don't know how much money we have. Well, depends on what day of Bitcoin is. We don't know ourselves. But the idea is that that's where the decentralized happens. And all of a sudden, when the bank starts going awry, isn't this a beautiful time to be in the likes of these crypto? Now, I've been someone who has dollar cost averaged in on the way down from 64 because I don't jump in on hype. I can see it going back to 64,000. And then after that, then I don't know. So what I've been doing is I've been dollar cost averaging in. And I think the last position that I jumped in was 21,000. And that looks pretty nice at this present moment in time.
Yeah, I mean, look, I think it's important, as always, when something happens, afterwards, the market tries to find a narrative to follow price, basically. And I think what's happened here is I think this is a classic case of correlation that doesn't necessarily mean causation. So even though the banks completely collapsed, and we understand why, I don't really think the banks collapsing was the reason for Bitcoin to go up, to be honest.
Just give me a second, Arno. So guys, anyone on the webinar, if you guys agree or disagree or have actually a point, just pop it into the chat and we will discuss that as well. So make sure the chat, you're absolutely getting your point across there and actually understanding what's going on and popping stuff in there. And then we will discuss what you guys have said as well.
So, I mean, in a nutshell, we know banks have failed. Absolutely. We know stocks have tumbled massively and crypto has pushed up as they fell down. However, when it comes to crypto, among the various other drivers out there for crypto, there's really two main things that, in my opinion,
demand.
Well, to some extent, that's one. But rate sensitivity is a massive one, and the other one is liquidity. As a classic risk asset, crypto likes it when there's a lot of liquidity in the system, and it likes it when interest rates are super low. Now, the reason why crypto went into a bear market alongside regular stocks at the start of 2022 was because liquidity was drying up. The Fed was moving into quantitative tightening. They were hiking rates aggressively. So when those two things that stocks and other risk assets like crypto have in common, when they go up or liquidity down and rates up, that's normally a bad environment for anything risk sentiment related. Now, when it comes to liquidity and rate sensitivity, I think that's been the main driver here for these moves, because the first thing that we need to watch out for is the Fed's balance sheet. The balance sheet got a huge pop to the upside. Now, this wasn't QE. This wasn't the Fed backtracking on quantitative tightening. This was literally just them providing more liquidity for the system with all of the banks suddenly failing. So this was them coming out saying that, okay, don't worry, there's enough liquidity in the system. We'll help you out. There's more funding facilities, etc. That rise in liquidity.
When you say that, Arno, is that the same as UBS and the Credit Suisse sort of bailout, whereas Credit Suisse have now had 17 billion of the COS contracts just disappeared? Is that what we're talking about? A company that we can just write the debt off and go, oh no, it's fine. You don't have to pay that. It's fine. Forget about it. Look,
for the A1 bondholders, they're having a very hard time, right?
I have a couple of loans there. If you can say your banking friends to look, they can wipe that off as well.
The liquidity is mostly central banks, right? It's the SNB stepping in, giving UBS, 100 billion credit line, saying, hey, if you run into trouble, we've got your back. Don't worry, we're going to provide the liquidity for you to run through this mess. So what you have on this chart here, you've got Bitcoin in blue, and the orange line is basically a very simple liquidity tracker, which it's a little bit more robust compared to the just normal balance sheet. But what you notice is that when Fed liquidity pushes up or reduces, you normally see a very immediate impact on crypto markets, right? So liquidity, I think, was the first thing that drove this run to the upside. The other one, and this is really the simpler one, is just its interest rate expectations. So if we quickly take a look at this chart that we've been looking at, right, and we just pop in this line here, what this line tells us, this is the federal fund futures. So Fed fund futures tells us what the markets think interest rates will be. Now, just a couple of weeks ago, you'll notice that exactly when Bitcoin pushed up, right, Henry, that's exactly when this line rolled over. And that is as interest rate expectations fell through the floor. The market was expecting a federal funds rate of close to 5.6%. That is now down to 3.9%. As long as this light blue line remains low and liquidity remains high, then there's really only one way for risk assets to go.
So that's the identical. So that second blue line there is identical to the banks as well, yeah? Exactly.
The reason why this blue line fell is because of the credit growth expectations, right? So if this is a potential systemic threat, then obviously there's going to be ample liquidity. So liquidity jumped, interest rate expectations fell, and that gave way for risk assets to rally. So I don't think this is, Bitcoin as a safe haven. I think that's a bit of a dangerous one, unless of course you like your safe haven falling 80% in value, in the course of a few couple of months. I don't think that's really a safe haven, but I think there's good reasons why it's been rallying: liquidity and rate expectations.
Well, you say that it comes down to supply and demand, doesn't it? And one of the biggest supply and demand things here is that we have seen huge momentum on the likes of people buying this up. So yes, obviously you're going to see a jump in liquidity. That's part and parcel of the game. But also we've had a little bit of confirmation from people, the people that have been looking at this and wanting this to go up. We've now come across and we've now jumped in and we've got the market to go. So it was that catalyst we've had the likes of FTX go under. We've had the likes of the underlying, what was it, the link coins linked to the USD, they've dropped. You know what I mean? Everything over the last year has been negative on the likes of crypto. Yeah. This is the first bit of good news it has taken this year, isn't it? This is the first bit of news.
Absolutely. I mean, for me, from a purely tradability perspective, right? The volatility is something that just freaks me out when it comes to Bitcoin. So not really a trader when it comes to Bitcoin, but there's definitely a part of my portfolio that is sitting in this. But with this happening, this has been the first time when I've thought about maybe adding something to that portfolio, because now it looks like conditions is a little bit more favorable. But there's still risk in the system. I mean, for now, they've tried to do a really good patch job in terms of liquidity. And obviously, if interest rates get cut, that's going to create further fuel for the fire. The one just key challenge is that if the US do eventually go into what many expects to be a hard landing recession, then that dry up in credit growth is expected to hit risk assets across the board. So equities could have a really good next couple of weeks and months. If we don't get any more bad news, if interest rate expectations continue to stay low, if liquidity continues to stay high, risk assets across the board, whether it's, just the NASDAQ or Bitcoin, should do well. But we just need to be conscious of, if there is eventually a big dry up in credit conditions, that's going to lead to a potential hard landing, and most risk assets struggle in that type of environment. But that's probably only, a little bit later. That's only maybe Q3 onwards.
So to someone who wants to trade sort of the banks,
Yeah.
what would your sentiment be them, or how would we get in, and how would we actually look at the banks and say trade those at the moment?
Yeah, look, when it comes to bank names, if you sold them 2 weeks ago, you have very favorable risk reward. If you want to short them right now, you've got a couple of challenges when it comes to risk reward, right? So I wouldn't want to be short the bank stocks right here because they've just seen so much downside already. The other thing that we need to be wary of is, we just had news over the weekend again about the Fed potentially looking at extending their lending facility to some of these banks, especially the likes of First Republic Bank, which is, dropped 90% in the last couple of days. If that type of news comes out, it's going to be favorable for these banks. So from a cyclical perspective, you want to be short. You wanted to be short bank stocks anyway, from a purely economic cyclical perspective. However, I don't want to be short them right now. I think the best way to trade these markets, I don't want to be invested in bank stocks. If the cycle turns and we see growth starting to accelerate again, inflation looking more tame, then buying dips would be interesting in some of these names. However, right now, I think it's a trader's market. That means that waiting for very bad news and then you short bank names, waiting for good news like liquidity provisions or additional support like blanket insurance provisions for those uninsured deposits. If those things hit the wires, you probably want to be long a couple of these names. But it's a trader's market right now, in my opinion, Henry. I wouldn't want to be short this at these levels, and I don't want to be long them right now with the economy expected to fall off a mini cliff later on anyway.
So we've had a question there. So how can crypto be a safe haven when you can't investigate it or its ownership of securities? Now, see, the thing with this is that it is a good question, and look, he's smiling there going, I should have thought of that one. But that is a very, very good question. But there's loads of assets out there that people don't ever take ownership and they still invest in it. Look at an ETF. How many people here trade the SPY and the QQQ? Have you ever taken ownership of that asset? No, you haven't. The idea is that tracks what the likes of the S&P and the likes of the NASDAQ does. So there's no ownership taken of that. Now, yes, you can at some particular points, but the same with the likes of the crypto market. You're not actually buying that physical crypto, which you can get and stick into your wallet. I understand that, but again, there's no regulation in it, which means then it's a Wild Wild West asset. But what comes with a Wild Wild West asset is that it can take off, and if it takes off, the upside is unparalleled in any markets we have running at the minute. So at this present moment, scared money is running into two assets. One, gold, which is the traditional asset that it's at almost at a record high. It almost hit the 2,000 mark, and then also Bitcoin, which is now running massively as well. So there you have old money and you have new money. Now, all the jokes about old money knows what have to do, and then new money is easy come, easy go, and that may happen. But the likes of with these runs at the minute, what we have to do is they will have peaks and they will have troughs, and what we have to do is we have to jump out when we feel it's hit that peak. And then when it drops again, then you buy it back up again. So how many people here bought crypto in 2018? And over the next year and a half, it went the whole way down to 3,000 again. And then all of a sudden, then it took off, went up to 64,000. And now you've sat on it the whole way back down to 19. So the idea is when to get out, hold on to that, and then get in at the bottom. So get in near the lows, get in where you see value again. So yes, I understand that you can never really confidently take ownership of it. But again, to trade and invest, you don't ever need to take ownership of it. When you know when the peaks are, you know when the troughs are. When we have bull runs, you jump in on that, let it run, wait for phase twos, and then scale into your positions. And they're the ways we should be looking to invest and looking to trade in the likes of crypto at this present moment. So from what Arno's saying, he says, don't invest in banks. So I will take that as yes, you should invest in crypto instead. Yes, absolutely. So the debate between banks and crypto is the winner at the minute. Absolutely, yes.
Look, I mean, think about it this way, right? If you invest X amount, are you happy to lose that X amount, 80% of that at any given moment? Then investing in crypto is definitely for you.
Look, he's supposed to be taking the bank side of things now. Look, crypto have won. Yes. So look, guys, this is sort of the stuff that we're doing. Arno is doing a webinar every single day of the week. So we have the London Open every morning, and we also have the US Open every midday. So these are the types of webinars that Arno's going to be doing. If this type of insight was helpful, they're there. We've partnered with Varianse, so Henry Ward Co.uk is partnered with the likes of Varianse, and anyone who deposits in on the broker has access to these webinars. We also send out content every single day of what is coming up. So Arno puts together a pretty detailed analysis of what's happening, whether we expected the market to go up, what's happened today, how it's going to affect the market tomorrow, and all that scenario. And then anyone who deposits in the next week, we have 5 spaces. Anyone that does that, let me know. You get 3 half-hour one-on-ones with myself, and that means then once the 5 places are gone, they're gone. So just let me know, anyone who has done that, and then you get the free one-on-ones. So has anyone got any questions for myself or Arno? It doesn't have to be necessarily for banks. It can be for anything or any assets or anything like that. Anyone want to ask any questions before we finish up? Sorry, I'm late. Tyson has just arrived. Tyson, we are finishing up. But the question was, is there any questions that you guys have or anything about any markets that you want me to or Arno to quickly go through before we finish up? Our sessions recorded? Yes, they are recorded. So Jane, you would have missed this morning's session. I'm assuming you got a message on that. What's your favorite stock at the moment? Arno, what's your favorite stock at the moment?
Individual ones,
yes.
Nothing. What I'm looking at now, however, is rate sensitivity. So the NASDAQ would be one I'm looking at. So not individual stocks, but more index level. I think the NASDAQ has more room to run if barring any bad news on the banking side.
Now, when you say run, to the downside or the upside?
Up. We're currently testing, let me quickly show you guys here. We're currently testing interesting levels of resistance here, both on the S&P as well as the NASDAQ. So what I'm looking for here, you can see we've got a massive level of resistance coming up here between, let's just call it 112.80 and 13,000. If we're able to crack above that, I'll be using any type of pullbacks into that as an opportunity to look for further moves to the upside. We've got some key levels to watch out for to the upside as well to target. So 13,200 would be the first one. Above that would be 13,600. The other one to watch out for is the ES. I mean, we've been seeing a lot of compression lately. We've just been stuck between that 250-day moving average. If we're able to pop back above that, I'll be targeting these highs to the upside if we see a break higher. Obviously, again, that's barring any bad news on the banking side. As long as we don't get bad news, the fact that interest rate expectations are falling, the fact that liquidity is high, should see these assets supported without any bad news in the system.
Right. So to give a little to answer that question is, what stock am I looking at? Well, look, there's no coincidence here. I have 2 stocks that I massively like. One is Nvidia. Nvidia are absolutely running at the minute. They're flying. Their earnings are good. Content is good coming out of them. What they're doing is very, very good. Everyone uses their chips. That's that. And then a lesser known stock is Crocs, and it's been something I've been going on about for the last year and a half. Crocs is just a money making machine at the minute, and we actually traded and also invest in it as well too. It's a phenomenal, if you pull up, I don't know whether you can pull up CROX, please, if you don't mind.
Let's quickly go to, let's do this one. What is that you said, mate?
CROX. There we are, the top one. So look at that, look at the trend on that. It's absolutely flying. If you zoom in a little bit, we had a double bottom down there at the two lows there. Perfect. So we actually traded that on the first one, went up to a 3-to-1 in 1, 2, 3, 4 days. And then there was another entry on the double bottom. So the second entry was there. So yeah, at the minute, we're probably about 1% up on that. So that's something that I have invested and traded. And it's
what industry is that, mate?
It still has loads of room to go till the previous high. So another question that came in there: what cryptos do you trade? So for me, I trade all the majors. I don't mess around with sort of the altcoins. I look at, I've traded Bitcoin, ADA, Matic, Ethereum, XRP, not so much. XRP is in a massive sideways range. So I actually trade XRP between those two levels. Once it hits the bottom level, we'll trade it almost up to the top. When it hits that top level, I'll trade it almost down to the bottom again. But that's the idea. Okay. Everyone, it's been an absolute pleasure. Arno, thank you very much. It's been an absolute pleasure. Out of this, crypto has been the resounding winner. Absolutely. Thank you very much, everyone. And we'll speak to you on the next one. If you haven't jumped in on any of these before, make sure you're on Arno's webinars every morning, every evening, or every morning, every US Open. Okay, everyone. Been a pleasure. Thank you very much. Bye-bye.
Thanks, guys. Take care.